If you are planning to take a trip abroad, you will now have to pay a lot more TCS or tax collected at source. Come July 2023, be ready to pay up to 20% tax on booking overseas travel packages. The budget 2023 has increased the tax collection at source TCS rate for foreign remittances under the Liberalised Remittance Scheme (LRS) from 5% to 20%. What this means is that remittances for booking overseas travel packages will now rise from existing 5% to a whopping 20%. Except, of course, for education and medical purposes, there's a separate slab for that. The enhanced scope of TDS and TCS means that the government will be making a lot more money on the back of tax collected from people who are making overseas investment, taking international travel routes, and also transacting internationally. But imagine this, a salaried employee is already paying income tax and is going to suffer again a 20% tax for spending money abroad. How fair is this? We are going to discuss that and a lot more. Joining us at this point in time is Gautam Nayak, who is an expert and will be taking us through all the details that are coming in as far as TCS, which will be applicable from July, is concerned. Also with me in the studio is my colleague Karthik. Karthik, coming to you first, it sort of is a double whammy for a person who's already paying tax and then going abroad and paying additional.
Absolutely. So, Shweta, why was the concept of LRS really introduced? It was introduced back in 2003 as a limit on the amount of money that an individual can remit outside of India. And that limit has been set at $250,000 US. So any equivalent of that is what you can legally remit outside of the shores of India. Now, this money, of course, can be remitted in any form. There could be travel, tourism, which straight away comes to mind. It could be remitted for, let's say, education purposes, healthcare purposes, or let's say you have a family member who is abroad and as charity or as donation or as help to a person you know outside of India, you can remit this money. Up until now, of course, the TCS, the tax collected at source, was limited at 5%. Now, the rules from 1st of July, as I understand, are changing, and this, of course, was mentioned briefly by the finance minister in the budget speech, but the details of which are now coming out suggest that this 5% is now 20%. So, an example would be, let's say you want to travel abroad for a holiday and you want to convert some foreign exchange. You want to buy US dollars at the airport. Now, when you write a check or you swipe your card for, let's say, 1 lakh rupees equivalent worth of dollars, there is straight away going to be a 20% cut on that 1 lakh. So, 20,000 rupees straight away goes to the government as tax collected at source. Okay. And the conversion happens on the balance 80,000 rupees. So, obviously, for you as an individual, it's a big hit. Now, of course, if you are a tax paying citizen, and I'm assuming you are like many of us, if you're a tax-paying citizen, obviously, when you file your tax returns the next year, this tax which has been filed already, which has been collected by the government, could be refunded back to you if, overall looking at your financial statement. But yeah, it becomes a sort of, pre-tax that you already offer to the government. And it stays with the government till as long as you file your returns, and when applicable, it comes back to you.
Which is approximately a year.
Depends on when you're traveling. Okay. So, if you're traveling on 1st of July this year, you pay this 20,000 rupees, given the 1 lakh example that I just gave you, you pay this 20,000 to the government today and on the 1st of July, and you file your return maybe on the 31st of July the next year, which is usually the date. You file your returns on the 31st of July, and if there is a credit note due by the government to you, then this 20,000 comes back along with the rest of your refunds, which could take anywhere between a month to 3 months or so.
Okay, interesting there.
So, about 15 months roughly if you travel on the 1st of July. If you travel, let's say, in the month of March, then again you file your returns on the 31st of July, and it comes down to maybe about 6 months.
Okay. Gautam is also with us. Gautam, what do the new changes in TCS mean for people who are aspiring to travel abroad or making overseas investment? We just heard Karthik talking about sort of a double whammy for an average person who's already made, he's the tax outgo and has already given some sort of TDS. And then again, when they're planning to go abroad, taking a tour, on the package that they're going to pay additional TCS of 20% seems like too much for an average person.
See, Shweta, the way I look at it is that it's a additional cash flow outflow for the person. That today, when you book your tour or you make a foreign payment, you're paying an extra 20%. So if your package would normally have cost you a lakh of rupees, you would end up paying 1,20,000, and 20,000 is the tax which is blocked up with the government. As Karthik mentioned, it's until you file your return, you get it back. So the problem really is this, that today, if my, say for instance, if I'm taking a tour which costs, for my family, I'm spending 5 lakh rupees, maybe a lakh of rupees would be deducted, would be collected by way of TCS in addition to that 5 lakh. So I would first have to find funds for that 6 lakhs. Secondly, on that 1 lakh, my advance tax liability, particularly for a salaried employee, my advance tax liability may be 10,000 or 15,000 on my other income. So for the remaining 85,000, I really have to wait for at least a year, or maybe 6, 7 months at the minimum. And the worst part of this is that today, on TDS or TCS, if you've paid if there's an excess TDS or TCS and you get a refund, the interest which the government will pay you will only be from 1st of April following the end of that year. So therefore, so instance, you made the payment for a travel package in the month of July, the example which Karthik gave, you paid in July for that package. The TCS was collected at that point of time. You paid a lakh of rupees at that point of time. Now that lakh of rupees, you would get interest from it only from April of next year till the date that you get your refund. So your money is stuck. You will not have that money with you. You have to find ways to finance that immediately. And, the worst part is that for the money that you've given the government, which is, you do get interest only for a shorter period of time. That's the whole problem.
Okay. And since you're a personal finance guy, Karthik, if I were to have this money invested in an FD, I would get better returns.
Yeah, so let's say a 1-year FD today, practically every private sector bank is offering you about 7% interest rate. So I want to ask Gautam, what is the kind of interest calculation that the government does?
They will give you 6% from April till the date that you get your refund. That's so lower than a bank fixed deposit rate.
So if you travel on the 1st of July this year, you could have got, let's say, a 7% per annum interest as way of investing that money in a fixed deposit for a period of 1.5 years, whereas in this case you get a 6% interest for maybe as little as a 6-month horizon and not a 1.5 year horizon. Is that right?
That's right.
Okay.
That's right. So in effect, what you're doing is you're giving an interest-free loan to the government, which the government is paying you interest only for the part of the period, and that too at a low rate lower than the FD rates.
Okay.
So Gautam, why don't you help us understand here, what is this total volume? I think you've run some numbers. What is the volume of total remittances that go out from India, and how much does the government actually create as an interest-free corpus for itself?
The refunds, if you look at the refunds were around 3 trillion rupees last year. And, if you see, the refunds went up by almost 59% as compared to the earlier year. So that's an indication that the TDS and TCS which is being collected is far more than the amount which is warranted. So that's one indication which is there. Further, from this TCS which is now brought in, will further increase the refunds which will be due, I'm sure, because, see, as I said, salaried employees will be the worst hit because they're the people where TDS is deducted in any case on their salaries. Their other income, the tax isn't enough to absorb this TCS. If I'm a professional, I can easily absorb it against my advance tax liability. I just pay less advance tax. So the amounts involved are, as I said, the refunds is around 3 trillion. Now, how much of that is due to this TDS, TCS, etc.? The broad numbers are not available. I think it's not in the public domain. But one of the things is what you have to remember is, earlier there was also a 7 lakh limit which was there for all other remittances. So today, say, look at this TCS situation. It was only for overseas tour packages. So therefore, if I book the overseas tour package, which could be only hotel and accommodation, or it could be include the air ticket plus the hotel accommodation. In that situation, there was a TCS. So if I could book the air ticket myself and I booked the just the hotel stay separately, etc., then it was not a booking of an overseas tour package. I could avoid that TCS. Now, the worst part is that all remittances under LRS would be subject to the TCS, irrespective of the quantum involved. That 7 lakh limit would not apply. Of course, it didn't apply to an overseas tour package last year as well. But now so today, let me give you an example. I mean, you subscribe to Apple iTunes. So you pay something, which is really part of your LRS remittance because you're paying it in foreign currency really. So therefore, on that also there will be a TCS. I'm saying that there are so many small payments. I subscribe to the Economist magazine, and there will be a TCS on that as well because it's ultimately being paid in foreign exchange. It's part of my LRS limit. So that's where the scope is much wider. It's tours is one part of it. Uh, it's
So
much
just to
wider the
clarify
scope.
this
And
point, if I were to book my ticket myself, I wouldn't be paying any TCS. Is that correct?
no, that's right. Because see, so far as tickets are concerned, you don't take that in foreign exchange, and therefore there will not be, and that's not part of your LRS limit. The LRS limit applies where you're taking foreign exchange, where you're utilizing foreign exchange. And for a ticket, whether you book it with an Indian airline or a foreign airline, there is no foreign exchange payment so far as the resident Indian is concerned.
Okay. What's the rationale behind increasing the TCS limit from 5% to 20%? But the government comes out and says the only reason we need to widen our base for TCS and TDS is because we want more and more people who are evading taxes to come within the tax bracket. But in this case, a whopping jump from 5% to 20%.
No, Sweta, see, if I can track with 20%, I can as well track with 5%.
That's
I'm getting the
correct.
same details. That's right. So there's no logic to that. Frankly speaking, I think there is a little bit more to it that meets the eye. You know, there are two things. One is that the government is getting an additional float money for which they don't have to pay any interest. So therefore, it helps tide over the fiscal situation. That's one angle. The second angle, and which possibly also could be that, particularly so far as LRS payments are concerned, is, as you know, that the rupee has fallen against the dollar in recent times. We've seen almost a 10% drop in the rupee vis-a-vis the dollar. From 75, it's gone up to 82 or so. So maybe the government wants to discourage people from spending in foreign exchange so that it conserves the foreign exchange reserves. That may be one of the reasons behind this.
So, do you see, Gautam, this also sort of tying in with government promoting tourism within India? Do you see this with foreign universities setting up shop in India? Overall, do you think this discouragement has got to do a little beyond economics and more society and social sort of equilibrium to be maintained in India rather than abroad?
Well, I think really it is to some extent economics, I mean, which is driving the government. I don't think really, if you look at it from a social perspective, I don't think that's it's not to encourage tourism within India. I would say that it's more to discourage people because, you know, the very fact that they brought all RRS under the scope and without the limit of 7 crore, and that, 7 lakh, that really demonstrates that the intention is that they don't want to encourage people to use foreign exchange. That seems to be the intention very clearly. And at the same time, the government gets the benefit of an additional float.
Okay. And what about themes like education and healthcare? And these happen to be fairly large chunks that that account for the remittances that individuals make for the family studying abroad or for, let's say, any emergency healthcare service that arises which needs treatment internationally. Is this 20% applicable in those scenarios as well?
No, I think fortunately they have a concessional rates there for medical and education. They have a 5%, and for certain types of educational institutions, you know, where you've taken the educational loan, which follows under that qualifying amounts. So there it's only a 0.5%. So that's the clear this. So those cases, fortunately, I think will not have to suffer so much. So, but you know, what's the irritation, frankly speaking, I think is going to be the you know, they're talking about even all your credit card spends in foreign exchange. So today, as I said, you know, some small payments you make, you would obviously be subjected now to TCS. You will have that additional amount coming in. Now, claiming that credit means when you fill up your return, you've got to fill up all those details in your return, you know, about the TCS collected. The TCS may be some 10 rupees, 20 rupees, whatever, you know, minus small things, which will take up a lot of unnecessary time, frankly speaking.
Okay. So from what I understand, Karthik, it's not just about government getting a loan of 3 lakh crore per annum, which you know, for at least a year is not taxed, and then you're paying a substantial interest of 6% from the date you file, which is for approximately 6 months. It's also the fact that it's very cumbersome for an average person to file returns, and also for deductors, people who are deducting taxes. I think it's just unnecessary, cumbersome process that makes the whole thing very tardy and makes, you know, a whole lot of people try to evade taxes.
I have a feeling, you know, this could be one of the sublime messages behind this move, simply because it's impossible for you to keep track of every single transaction and the TCS that got deducted on that. I mean, of course, you're talking about a plethora of paperwork, but that paperwork only for somebody who really has the time and the energy and the
Bandwidth.
wherewithal
Absolutely.
to collect all that data and all that paperwork.
And one who
You travel
understands as
abroad,
well.
you swipe your card from a metro station to a bus ride to, you know, any restaurant that you're spending in. It's going to be impossible for you to hold on to those bills for a period of about a year or so until you file your taxes, and then make a note of every single entry and give it back to your chartered accountant. And on the other end of the spectrum, we are talking about Saral tax, Suvidha, and you pay your taxes yourself, you pay them online. I think it's a great job for chartered accountants today, because they're going to be back in business as I see it.
And you know, Gautam, please do come in here, but with the lack of awareness about finances in this country, and we know for a fact that there's not a awareness when it comes to filing of returns, when it comes to, you know, timely filing of returns to be particular, it makes it all the more difficult for people to actually claim back, as you rightly pointed out, from place A to place B, and the amount of money that they're spending, and then collect all those receipts and be able to file it back. So a large part of the money, therefore, actually goes to government coffers.
I agree, and I think that is what the government will eventually play with. This is going to be unaccounted money lying with them that nobody puts a claim to.
Absolutely. Gautam?
If I may just correct you over here, see, the way it would happen is that the deductor would be the bank who has issued the credit card, etc. They would be collecting the taxes. So they would be filing their TCS return, and which would reflect in your Form 26AS, which is like your online tax ledger. So therefore, you would download that online tax ledger, and you will have all the details of what is the taxes collected at source. So you don't really have to maintain those vouchers and details, etc. Because automatically, when you make the payment through your credit card, that will be captured, that will be collected by the bank, and they would have to do all the hard work of collating all that and filing the returns and ensuring that you get the credit. So that's the way it would work. So in a sense, once you download your Form 26AS and upload that into your return, then it would all get captured. But it's a hassle, frankly speaking. The larger the Form 26AS, the more difficult it is. And that's the only hassle which will be there. So a lot of people filling up their returns will find it more cumbersome to enter all these, to make all this entry. That's the problem which will happen.
But Gautam, correct me if I'm wrong, you get the Form 26AS only from your bank, and if you're subscribed to a credit card from your bank, these entries will get recorded and matched. But what if you're using the service of a neobank, or let's say, you know, a service like an American Express, which does not operate a saving bank account? You don't get your Form 26AS from those kind of credit card offers, do you?
No, see, the 26AS is an online ledger of the income tax department. What happens is, even if American Express Bank is issuing cards in India, and they are collecting, they will have to collect tax at source. That tax collection at source, they will have to file a return with the government. The government, on that basis of your PAN number, which the American Express Bank has entered in their tax collection returns, on that basis, they will aggregate it against your PAN, and that's how you will get your online tax ledger. Which is the Form 26AS. That's how it would work.
And is this going to be applicable even on UPI? Because now UPI acceptance, as we've read, is sort of, you know, penetrating geographies beyond India as well. Now, if you're not using a credit, but if you're actually just using your scan and pay a debit facility, I'm assuming that the TCS is going to be applicable in those instances as well.
Yes, the challenge, I think, will really be for the banks. And that's where I think the finance minister recently, when we were talking about the RBI policy, etc., he mentioned that the banks will have to gear up to capture all this information on the credit card payments, as well as on the debit card payments, whatever, or UPI payments. So all that will have to be captured. It's to be the bank's responsibility to collect that tax at source, because they are the ones through whom you're making the payment. So that's going to be the challenge as to developing the software within such a short period. I think that's going to be the real challenge for banks.
Okay. For the benefit of our viewers at this point, Gautam, what if I'm traveling, and I know my tax liability is different if I'm traveling for educational and medical purposes, but could you please explain to our audience at this point, if I'm traveling for educational purposes, which is going abroad to get a degree for 1 year, a master's degree perhaps, in one of the European countries, what sort of liability do I have?
So, as I said, for the educational fees, it will be 5% would be the amount which you would end up paying in most cases, because that's the limit which is there. The 5% for the lower limit is there for so far as this is concerned. But so far as your staying expenses, etc., concerned, so on that it would be 20%. The problem really is that if it's the student who's funding himself, and the student is not likely to have income in India during that year because of the fact that the person is going out of India. So the entire amount will then be really held with the government. It will come back to you only after a year. So you would need to fund that additional amount, the 20% on the living expenses or the 5% on the fees, education fees. So you would have to fund that yourself in addition to what. So therefore, if you're looking around for loans today, you might need to find additional amount to even fund this tax collection at source. That's the real challenge.
So I was just about to come to that. So if I take a loan of 20 lakh rupees to get a degree abroad, the tax will be collected at source by the bank that's giving me the loan?
No, it's when you're making the remittance. So if the bank is making the remittance on your behalf directly to the educational institution, yes, they would collect it. So whichever bank is making the remittance, they are the ones who would have to collect the tax at source.
But just to take Shweta's query forward, Gautam, it seems a little unfair because if you're pursuing an education, a master's degree or something abroad, one of your key expenses to earn that degree is travel and living internationally as well. So exempting the tuition fee but not exempting the travel and stay and other expenses that you incur on account of your education again seems like a major jolt for those who are genuinely going to pursue higher education or for that matter availing of a healthcare facility.
Absolutely, absolutely. It's a big hit to them, I think, because now they need to arrange for additional funding, without which they will not be able to make their dream come true.
And what happens, let's say, in the case of, again, I think the cap on that is also up to 7 lakh rupees, right? So,
That's right.
Is 7 lakh actually enough to support any international degree or cover for any medical expenses internationally?
No, I don't think in any way, 7 lakhs is too small an amount. I think in most cases, it will be more than 20 lakh rupees, and that's where the real challenge is going to be, because even on 13 lakhs, if you consider a 5%, which is, of course, it's 65,000 in that situation. But your travel expenses, when you add to that, you're still adding, and it is going to be a challenge funding that. That's the whole.
Okay. What about investments made internationally, Gautam? So there was a time during, let's say, between the first and the second wave of COVID, when international markets were looking quite lucrative and you had these fund of funds being offered by so many asset management companies. And there were, these fintech platforms sort of enabling you to invest your money in global equities as well. Now, all of that also comes under the ambit of LRS and comes under the ambit of 20% tax deduction.
No, I don't think so. Karthik, where you have a fund of funds, say, which is established by Indian mutual funds, say,
Yeah.
you could have an Indian mutual fund which has a fund of fund which invests in ETFs overseas.
Yeah.
In that situation, this would not get attracted because there you're not subscribed to foreign exchange. But, there are many platforms where you can
Direct
buy foreign
equities.
securities directly online. You can buy shares, you can buy mutual funds, overseas mutual funds directly online. Now, on that, you will also have to pay that additional 20%, which will be tax collected at source, and wait for it to be adjusted against your tax liability when you file your return.
Okay. And in case you end up making a loss on the investment that you've made directly abroad, then will that loss offset this TCS in any case for you?
No, Karthik, see, the way it works is, irrespective of whether you earned any income or not, this tax is collected at source on your gross remittance. Okay. So therefore, you would have to pay it on the cost of the shares, whatever is your cost of your shares. You spend, say, 5 lakh rupees on that, you would have to pay this 20%. So another lakh of rupees is what you have to put aside. And that 1 lakh will be adjusted against your overall tax liability, irrespective of whether, if you have, if you've not earned any income, then you will get that back as a refund. But as I said, with interest only from April till the date of refund. But otherwise, you can, if you made a bumper profit, fine, you can adjust it against your tax liability. That's the way it would work.
Okay. And tell me one more fundamental question here, Gautam. This LRS was introduced back in 2003, if I remember correctly, and the limit was set at $250,000 as the maximum amount that an individual with a PAN card in India can remit abroad. Now, in the last 20 years, we've obviously seen the rupee also depreciate drastically, and we've seen inflation across the world rise. Do you think there is an overall merit in re-looking at this figure of $250,000 US?
Karthik, no, the limit was $25,000 when it started off in 2003. So it was $25,000. Then what happened is it went up to $75,000. It went up to $1 lakh dollars, then $200,000. Then there was this crisis which came in 2012. There was a foreign exchange crisis in August 2012. The limit was slashed to 75,000 from 200,000, slashed to $75,000, and all sorts of restrictions. Now remember, initially LRS started off saying that this is only for capital account transactions and not for current account transactions. So expenses such as travel, such as subscription, etc., all those were not covered by LRS. So they were in addition over and above, your LRS limit. Your LRS limit was only for capital account transactions. In 2013, when they restored the limit from $75,000 to $250,000, that's when they brought in all these restrictions, and they've said, okay, this $250,000 is both for your current account as well as your capital account transaction. So it will be for your travel, it will be for your education, it will be for medical, besides investments abroad, etc. So for all that put together, this limit is of 250,000 is there now. So that's the way, so therefore it has undergone a change over the years. And secondly, if the dollar appreciates, still, you're paying more rupees in terms of it. So really, it doesn't make a difference in that sense.
Okay. And one final trick question. What about cryptos? They're still not legal, neither are they illegal in India, and you really don't know who you're paying and how that money is getting remitted where. So how does it pan out in the case of somebody maybe, going to an Indian crypto exchange and investing?
See, so far as Indian crypto exchange is concerned, there is no problem. The problem is if you want to trade on a foreign crypto exchange, that is not permitted under LRS.
That's right.
So therefore, that's something which therefore this TCS would not apply to it. But Indian crypto exchange, of course, you have other tax provisions where they said that your gross gains would be taxed. You will not be able to set off your losses against the gains, even though you made losses in crypto, etc. So, so there are all sorts of issues there. So they're really trying to discourage people. I mean, the government seems to feel that crypto is a form of gambling in a sense, and therefore, in fact, worse than gambling, because in gambling, it's only your net gambling income which is taxed. But in crypto, it's your gross winnings and without setting off the losses which is taxed.
Right.
So,
Okay.
I think...
Okay, wonderful. Thank you so much, Gautam, with all those details that you just shared. Remember, it's an important story that we're tracking. TCS on foreign remittance has been now hiked to 20%. It was 5% until recently. It's a new innovative way for the government to make money.
I'm just glad, Shweta, it kicks in from the 1st of July because I have an international travel planned for the first week of June.
That's
so
wonderful.
I think I'm going to narrowly miss this. So in case you're planning your holiday, maybe do it in June or earlier.
Absolutely, do it in June.